Hello everyone. Today we are going to run the chapter 16, the distribution to shareholders. We call that payout decision. When firm invest the good project, they can generate some alpha, right? Generate some profit, and the alpha we call that the net income, right? And net income can be used two ways. The first one is retained earnings, and second one is distribute to the shareholder. We call that dividend, right? So main purpose of retained earnings is reinvestment. So that is also equity. So we called internal equity. So it is generate equity within the firm. At the previous lecture, we run optimal capital structure, but in payout decision, is there optimal amount of dividend to pay out? Yeah, some company has no dividend, or some company has large dividend, but we don't know which one is optimal point. So we can say, in terms of investor preference on dividend over the retained earnings, yeah, it can be set the dividend amount. And then we will learn the residual model. Residual dividend model can be used as long-term guideline to set up the future dividend. And lastly, we will learn the stock repurchase and stock split. These two are alternative methods. Dividend does not change much over time. So if the firm has large net income, firm can use the stock repurchase. We will learn more deeply later. So let's run together. This slide shows the definition of the dividend policy. Dividend policy means the decision to pay out earnings as dividends versus retain them. So we can summarize as this. The objective of firm is maximize firm value. It means maximize the stock price, right? So in this case, payout policy is regarding target payout ratio. It can be calculated by dividend over net income, right? So net income can be used two ways. Just distribute to the shareholder. We call that dividend, right? And the retained earnings for future investment, right? Do you remember this slide? We run at the stock valuation part. When investor buy a stock, they can expect two return, right? The first one is dividend yield. It can be calculated by dividend over current stock price, right? And second one is capital gain yield, right? The stock price change over current stock price. So we can calculate total expected return is dividend yield plus capital gain yield, right? We can write down the equation as this. To P0, the current stock price is D1 RS minus G, and we can rewrite the total return can be calculated by dividend yield and current stock price and expected growth, right? So when firm distribute dividend, they can expect the dividend yield, right? This part. So this is dividend yield, And second, when firm use net income to retain earnings for future investments, in this case, the expected growth rate increase, right? So in this case, we can expect the potential future capital gain, right? There is a big question about how to set the target ratio, target payout ratio. If the firm increase the payout ratio, what does it mean? This will raise dividend amount, right? So when dividend amount increase, the stock price also increase, right? However, if the dividend increase, the rest money will be available, right, for reinvestment, which will cause the expected growth rate to decline and tend to lower stock price, right? So therefore, any change in the payout policy will have two opposing effects, right? So optimal dividend policy must strike the balance between current dividend and future growth. In conclusion, the target payout ratio it should be based in large part on investor preference for dividend versus capital gain. So it should based on the investor preference. Going to run the investors' preference can affect the dividend policy, the target payout ratio. So the first one is investors are indifferent between the dividend and retained earnings, and second, investor prefer dividend, and the last one is investor prefer the retained earnings. According to the dividend irrelevance theory, the investors are indifferent between dividend and retained earnings. Let's suppose I want to receive the dividend. What can I do? Just buy dividend fund, right? The opposite case, if I don't want to receive the dividend, I just sell the stock, right? So investors can create their own dividend policy. But this theory is based on strong assumption. There is no tax, no transaction cost. So because of this, dividend relevance theory does not fit in the real world. The second one is investors might prefer dividend. So you may think dividends are less risky than potential future capital gains. So if so, investors would value high dividend payout funds more highly. So for example, high dividend payout would result in high stock price, right? Next one is the investor might prefer capital gain. There are two reasons: tax rate difference, timing of tax. So when you invest the stock, there are two types of tax. Tax rate on dividend and tax rate on capital gain. What do you think? Which one is higher? The tax depends on each country, some rules, right? But most of case, tax ratio of dividend is higher than tax rate on capital gain. So these tax rate differences, the investor might prefer capital gain. Second reason is timing of tax. In Korea, the most of firms set the dividend amount at shareholder meeting in March. Then firm distribute dividend to shareholder in May. At that time, investor should pay tax on dividend. So investor cannot decide when to pay tax in this case. However, when tax on capital gain occur, the investor sell the stock, right? So depending on personal situation, investor can decide when to pay tax on capital gain, right? So we can conclude that if the investor prefer capital gain, investor would value low dividend payout funds more highly, right? So a low dividend payout would result in high stock price. The one problem is we don't know which one is right or not. The investor might prefer capital gain or investor might prefer dividend. So it depends on investor preference. The high risk aversion investor prefer high dividend firm, and low risk aversion investor prefer low dividend firm. Low risk aversion investor prefer capital gain, right? So both are true, it depends on investor. There is no standard theory about dividend, so we can say just standardized facts in the stock market. The first standardized fact is the sticky dividend. It means the dividend does not change much over time. What's the source of dividend? The net income, right? The source of dividend here, right? Net income. Which has greater fluctuation, net income or dividend? Net income fluctuates more and dividend stable over time. So you can draw a graph as this. This is time and net income. It fluctuates a lot, but in the market we usually see the dividend it looks like this. It's stable over time and increase a little bit. It's stable over time and increase a little bit. This is one example. The GM, the General Motors dividend history from Nasdaq homepage. As you can see, in the 2014, they pay out the 30 cents, right? And they maintain the dividend amount. And after 2015, they increase a little bit, right? And then they increase dividend amount 2016, and after 2016 their dividend amount stable over time, right? And one interesting is dividend did not decrease over time, right? In most of the case, the managers hate to cut dividend. Why? The manager reduce the dividend amount is very negative signal because of information asymmetry. So there is some information asymmetry. Who has more information? The insiders, right? Insiders, we can say the manager of the firm. You can simply understand the CEO or CFO. And outsider is what? Investor, the stock investor. The company's news provides some signal which incorporated future cash flow will be. So when firm cut the dividend, it signals that the company's expected earnings is too low to maintain the current dividend payout. So it's bad news for investor, right? So stock price goes down a lot. The manager had to cut the dividend temporarily. So from this reason, the dividend does not change much over time. The second strategic fact about the dividend is the fund with more investment opportunity pay out less dividend. Because alternative of paying out dividend is retained earnings for reinvestment, right? So the funds with more investment opportunity pay less dividend, right? And increase their retained earnings for future investment. Yeah, that is the second storage pact. This slide shows the residual dividend model. From this model, we can calculate how much of forecast net income should be paid out as dividend. So the net income is the source of dividend, right? And target equity ratio, how can you know the target equity ratio? Yeah, from the financing decision, right? The financing decision is about optimal capital structure, right? The optimal debt proportion which maximize our fund value. In this example, that is 40% debt. What is total capital budget? A total capital budget means the total amount of money to invest a good project. How can you know? Yeah, from the investment decision, right? So for example, let's say there are 3 projects and this is a good project, bad project, and good project. How can you know? Yeah, from the NPV method, NPV positive number, NPV negative number, NPV positive number, and the required capital is $1 million, and let's say this is 2 million, this is 0.5 million. In this case, we invest only in good project, right? So this money, some of these 2, so we invest these 2 total capital budget, right? So when you calculate this part, you can interpret this as this. The required equity to support the project. So here is example. The capital budget is $800,000, right? And target capital structure is 40% debt and 60% equity. So this number is outcome of financing decision, right? And forecasted net income is $600,000. And now we want to calculate how much of the forecast net income should be paid out as dividend. Dividend amount can be calculated by 2 steps. The calculate portion of capital budget to be funded by equity. It is regarding this part, right? So of the 800,000 capital budget, we multiply the target equity ratio, right? So target equity ratio was 60%, so 0.6 multiply 800,000. and then get you some number, right? The number is 480,000. This amount of money will be funded with equity, right? And second, you calculate excess or need for equity capital. So there will be the net income subtract this number, right? So net income is this amount subtract required equity to support the project, then get this number. $120,000 left over to pay as dividend. So we can distribute this amount of money as dividend to the shareholder, right? So calculate the dividend payout ratio is dividend over net income, right? So dividend is this amount, net income is, so finally we can calculate dividend payout ratio. Yeah, that is 20%, right? So let me say again, this number comes from what? Yeah, target equity ratio, right? And this is capital budget. And this money comes from net income. And this amount is here, right? The required capital or required equity. And then finally you get this dividend, right? Net income dropped to $400,000. So in this case, dividend can be calculated by net income subtract this amount of money, right? The required equity. This amount of money should be funded with equity. So input the numbers. What happened? Negative number, right? But dividend cannot be negative, so we can write the 0. There is no dividend. So dividend payout ratio also 0%, right? And if the net income rise to $800,000, in this case, subtract this required equity, then get this amount of dividend, right? And dividend payout ratio can be calculated by dividend over net income, right? Yeah, that is the answer of this question. Here is one question: how would a change in investment opportunities affect dividends under the residual policy? So upon pure good investments would lead to this part goes down, right? So total capital budget goes down, it means dividend increase, right? The opposite case, if the firm have more good investments, it means total capital budget increase, right? In this case, the dividend decrease. So we can conclude that the purer good investments would lead to the smaller capital budget, hence to larger dividend. The opposite case, more good investments would lead to smaller dividend payout, right? This is comments on residual dividend model. The advantage of the residual dividend model is minimize the new stock issue. The new stock issue means external equity, right? But in the residual dividend model, we already calculate the equity here, right? The required equity to support the project. So in this case, the equity can be interpreted as internal. What is internal equity? That is retained earnings, right? So retained earnings for the future reinvestment, right? So firm retain a lot, it means firm have more internal equity, it means it reduced external equity, new stock issue. But there is disadvantage when firm use residual dividend model, result in variable dividends. As you can see, when firm's net income, projected net income is 600,000, the dividend payout ratio is 20%. But net income changed to 400,000 or rise to 800,000, the dividend payout ratio changed much, right? As we learned before at the stylized packs, there are some sticky dividend phenomena, right? It doesn't change much over time. But when we use the residual dividend model, it changes a lot. So we cannot use the residual dividend model year to year. Just we can use that when setting the long-term target payout ratio. So firm can use the residual dividend model as a benchmark or a long-term guideline to set up the future dividend. Now we are going to run the alternative to paying dividend. The first one is stock repurchase, and the second one is stock split. Let's run stock repurchase first. Stock repurchase means buying back stock from stockholders. So there are three reasons. The first one is to dispose of one-time cash. If the firm has large net income, firm should increase dividend? No. If the firm increase dividend, firm should maintain high level of dividend, right? As we learned in stylized packs, dividend does not change over time. If the firm reduce dividend, it's bad sign for investor, right? So when firm has large net income and it's temporary, not a permanent, in this case, firm decide to repurchase the stock. What happened to stock price? As we learned corporate value model, the price can be determined by value of equity divided by number of shares, right? So in this case, when stock repurchase, this part goes down, right? The denominator goes down, the stock price increase. So stockholders can have some capital gain, right? So it's benefit for the stockholder. The reason for stock repurchase, these two are not related with the dividend. Second one is related with the optimal capital structure. So to make a large capital structure change, firm can do stock repurchase. Do you remember financing decision? If the current debt ratio is lower than optimal capital structure, optimal debt ratio, firm issue debt, right? And proceed is used to buy back the stock. The buy back the stock means the stock repurchase. So in this case, number of shares decrease and debt ratio increase, right? So the firm can use stock repurchase to make a large capital structure change. The third reason is as an investment tool. So when the firm, the stock repurchase, does it mean this stock is overvalued or undervalued? Which one? Yeah, undervalued. The firm will buy back the stock when current stock price is lower than the fair price. The firm is at the better position to evaluate their fair price, right? So the stock repurchase, what is signal to the investor? Yeah, positive signal to the market, positive signal to the investor. So the stock price goes up. Stock split is a second alternative to paying dividend. The stock split means firm increase the number of shares outstanding. For example, let's say 2-for-1 stock split. In this case, before the stock split, let's say 100 shares, and after the stock split, the shares multiply 2 times, so 200 shares. So stock split increase number of shares outstanding. In terms of firm valuation, total value of firm change? No. Like a Yogi Berra story in MM's theory part, the pie, the pizza is divided into smaller pieces, right? When we run the corporate value model, the price of shares can be determined by value of equity over number of shares. And value of equity can be calculated by value of firm subtracted by value of debt, right? How can it get the value of firm? Yeah, from the free cash flow, right? The free cash flow means future earnings, right? So in this case, the future earnings does not change. So the pie is divided into just smaller piece. The firm value does not change. But number of shares increased 2 times, right? So what happened to stock price? Yeah, stock price cut in half, right? Why firm do stock split? There are 3 reasons. The first one is optimal price range. There is a widespread belief in financial market that optimal price range exists for stocks. So many observers believe that the best range for most stocks is from 20 to 80 per share. The optimal means that if the firm stock price is within this range, the firm value will be maximized. However, it's not theoretical and non-academic, so it's conventional reason. Accordingly, if the stock price rises to $80, management would probably declare a 2-for-1 stock split, thus doubling the number of shares outstanding, the lowering the stock price. The second reason is the signal effect. On average, the price of firm stock price goes up shortly after stock split, because investors often take stock split as a signal of higher future earnings, because only firms whose management believe that future earnings looks good tend to split their stocks. However, after the next few months, if the firm does not announce an increase in earnings and dividend, the stock price generally will drop back to earlier level. There's another reason firm do stock split, the signal effect. On average, firm stock price goes up shortly after stock split, because investors often take a stock split as a signal of the higher future earnings, because only firms whose management believe that future earnings looks good, these firms tend to stock split. However, after next few months, if the firm does not announce an increase in earnings, the stock price generally will drop back to the earlier level. The last reason is the stock's the liquidity. By creating more shares and lowering the stock price, the stock split may also increase the stock liquidity. These tend to increase the firm value. So from these three reasons, firm do stock split. We run payout decision, the dividend policy, right? So in this part, we run some tools, the residual dividend model. It can be used as a long-term guideline, how much payout dividend, right? Finally, we learned all three decisions of the firm, right? The three major decisions. The first one is investment decision, we call that capital budgeting. The second one is financing decision, we call that capital structure. And last one is payout decision, dividend policy, right? And there is one big question behind here. Who decide these decisions? A manager or the CEO, right? And they are human being. And human being has some characteristic to maximize his own utility. So we need some tools, the decision maker to implement to achieve the objective of firm. We call that corporate governance. And last lecture, we will learn corporate governance mechanism. Corporate governance part does not include final exam, so you can freely enjoy the last lecture. Thank you.